Let's start with if the stock is too expensive, which is the
Yes,
chart
so I
right
get
here,
this
right?
question a lot, and before we start into that, we can share the screen with the model, but I just want to give my thoughts on it. And the way I respond to this, they say, Joe, oh, it went up to 500 or 450 or now 420.
Yeah.
I missed out on 100% move upside. Now it's too late, right? Now I shouldn't go into Tesla anymore, or I should wait for a pullback. And I think this kind of thinking is dangerous because it's too tactical. Like you have to see the big picture.
Yeah.
And I always say when you get a quantitative question, which is a quantitative question, should I buy a stock at X price? The quantitative question, you need a quantitative answer, not a qualitative answer. You shouldn't say like, oh, it's too late. No, it's still good. You should also not say, oh, look, Tesla is such a great company. You should always buy it. These are all wrong answers because you need numbers. So
Right.
I want to share a model where we answer that very specifically and quantitatively. At what point wouldn't it be good to buy Tesla now?
Yeah.
Right. So
Before we
let's
start
go
the
into that.
model, what my explanation is when I tell people, or when they ask me, like, if the stock's too expensive to get it now, I'm just like, think about it. The stock is trading a little bit higher than what it was back in 2021. What has the company done since then till now? It has done nothing but grown. So
Absolutely. Of course, you
that
could
is
argue as a bear, well, it was completely ridiculously overvalued and now it's just overvalued. You're 100% right. No one can contest that wherever we are now, the company is much more valuable on a substance level than it was in 2021. But the question is still, was it ridiculously overvalued or was it fairly valued in 2021? Right. So that's why I like to have substantive models that look into the future, that have a future share price, and then reason back from then. Of course, you also have what I call the Wall Street normies, who just are, quite frankly, a little ignorant, and they have ridiculous share price targets, but no one should listen to them anymore. They watch most of the YouTube channels. Many
they've
of
been
them,
so
like
wrong.
Adam Jonas and Dan Ives, are smart cookies, and I think they watch all our channels, actually. I know they watch some of these channels.
Especially Dan
Right.
Ives.
Dan Ives is totally LinkedIn. And we have to understand, if Dan Ives says, oh, my share price, I don't know what his latest is, 515 or whatever, he knows it's BS, but he has a job. And his job is not to tell us the truth and to predict the price targets. His job is to make more money and make his career. And if you're in a big bank, right, Dan Ives, he can't just tell us the truth. He has clients who have expectations. He plays the whole Wall Street normie game. And the Wall Street normie game is, you don't make money by predicting the future correctly. You make money by convincing other normies, and in many cases, dummies, to give you their money. Institutional managers are often complete dummies. Like, look at pension fund managers. Have you ever seen who manages these funds? These are like, is it a random teacher who got voted California teachers pension 250 billion? They have zero clue about anything, and they have political convictions and all kinds of stuff. So his job is to convince these people that they should give his bank or his funds the money. And if he says anything they don't like, he doesn't get the money. That has nothing to do with the truth. So Dan Ives and Adam Jonas, smart cookies. I think they understand it. They watch our channels, but they can't say what they really think. So their share price target is always chasing the stock because they have to say something that convinces other normies. So that's what you have to understand. If you want to understand the future, watch YouTube. Don't listen to the analysts. But that doesn't mean the analysts.
And one thing I do want to add here is this works both ways for the Bulls and for the Bears. One good example that I want to mention is Gordon Johnson. Gordon Johnson, no, I'll be honest, like what he did an interview with Meet Kevin, I think it was a year or two ago. He is a low-key bull. Like, he said that I was going to put a buy rating on Tesla, but my clients told me don't.
Yeah. And exactly, we have to understand that it's always the same, Pejjy. That's a great thing you bring up. All these guys, also Gordon Johnson, no one is as dumb as his price target, including him. He knows it's a joke. So they are being clowns because they're getting rewarded for being clowns, right? Not because he's that dumb. He's not that dumb. So that's why YouTubers, you should listen to people who tell you stuff you understand that makes logical sense, like our models, and who do not have hidden interests. I don't manage other people's money. I don't try to convince dummies to give me money. I manage only my own money, and I want to be right. I have only one incentive, and that's the truth, because if I hit the truth, I make more money. So you can trust me that I seek the truth and tell you the truth, because I have nothing to gain here by not telling you the truth.
Exactly.
Same for Pejjy, of course. So
of course.
here's the model. The model works very simply. You have the share price of 10,970 in the year 2030, right? You see this here. So it's 10,970. You can change that number and put in whatever number you believe is the right number for 2030. But I think my model is pretty conservative. The odds are much higher that it's higher than lower. Okay.
Yeah.
Here you see the input number for 2025. People ask me, is it January? Is it December? It doesn't matter. If this is January, then this is January, right? We are not that accurate here with the 10,000. It could be plus minus 1 year. So let's say this is January 2025. So in 1 week, in 2 weeks. This share price, right? How does it relate to this price? Well, if this price is correct, then this is your incremental expected fair future value per year, right? In order to get here, 927 in 2026, 1,720. This is if it's not linear, but if it's increasing at a steady annual growth rate, CAGR. So I compute the CAGR, the compound annual growth rate, your annual returns, if they just keep steady to reach that number. So if you buy at 500, you will make 85% per year until 2030, if that number here is correct. Now you can play around with it. So you say, well, but Joe, it's not 500, it's 420. Let's wait. Maybe it is 500 January 1st, but let's say it's 420, it stays stable. You type in the number and you see what happens. If it's 420, if you buy at 420, you're making 92% per year if that number is correct. And now you know how these numbers correlate. If you have a price target, that is why these price targets for 2030 are so important for you today. If you understand that price target and you believe it's true, or you have a different one, you type in a different one, then you can compute your CAGR. Why is your CAGR so important? Because your annual growth rate of your capital tells you is the decisive decision-making point for you. Because is it too expensive? Should you buy it if you make 92% a year? The answer is, it depends what your alternative investment is. If you have another investment opportunity that makes you more than that, then it's not a good buy. Then buy the other thing. But if you don't see anything that makes you 92% a year, then you buy Tesla. And that allows you now to set basically your benchmark rate. What is the rate you expect your capital to make if there would be no Tesla? Let's say you have a portfolio and over the last 5 years you made, let's say 12%. 12% a year on your capital. Then this number needs to be 12% or lower in order to not buy the share. You understand, right? So you have, if you normally make 12% a year, at what point would you not buy Tesla stock in 2025? And now we can play around. What if Tesla would be $3,000 next year? I do not believe it will be $3,000. That would be ridiculous. But let's assume it would be $3,000. How much would you make per year until 2030? Boom. That's nuts. You would still make 30% per year. That means even at $3,000, you should buy Tesla if your benchmark rate is 12%. And that tells you how ridiculous this opportunity is. Because you have to go up to 6,000 or something, then you're at 13%. Even at $6,000 next year, Tesla is a better buy than anything else that makes 12%. That's why I think this is an insane opportunity, because my conviction level on that number here, on the 10,970 of 2030, is extremely high. For me, this is the lowest risk investment in the world. There's nothing that has a lower risk.
Yeah, I agree.
When I give share price models and predictions, I'm not like Gary Black or other people, Adam Jonas, who say, well, I'm modeling this out based on this assumption. This is the crazy thing. These people are saying, I did not consider Optimus, for example.
Yeah, right now.
And then I asked them and Gary Black says, I do not consider FSD. It's like, dude, what do you mean you are not considering? This is like saying I modeled out NVIDIA and it should be $1 because I'm not considering chips. It's like, I mean, if you model out NVIDIA and you don't model in chips, then something is wrong with you. Because isn't the whole point of NVIDIA that it's chips? It's like if it's like modeling out McDonald's, but you leave out burgers. Like, dude, you cannot model McDonald's and leave out burgers. What's wrong with you? So it's also, and then you ask people, do you believe McDonald's will not sell burgers in the future? Oh, of course, it will sell billions of burgers. So why don't you put that in? So it's the same thing with Tesla. Like people who model that out and leave out Optimus and FSD, or either one, I don't know what's going on. So of course, when I model it out, I model everything in that I believe Tesla will do in the future. And that, of course, is majority Optimus. Like Optimus is the central profit driver of the entire thing, obviously. And the second biggest is FSD. I actually believe I'm really lowballing FSD. I'm also lowballing Optimus, but Optimus is so crazy that when people see my numbers, they think I'm crazy and they don't understand it's going to be 10x my numbers. But I think FSD, I'm really conservative. I'm saying, okay, there's a pilot launch. There will be a lot of friction scaling it, but it will scale. It's a huge opportunity. And I get to 200 million robo-taxis by 2040, which is pretty conservative.
It's it's crazy. I had CERN on, and he's like, what do you expect robo taxes would be until 2035? And I'm just like,
you said 100 million.
No, well, I said 6 million by 2035 because my brain can't comprehend the exponential growth. And he's like, well, that's very low. He says, if your model is saying 163 million Teslas are going to be on the road and 100 million of them is operational, at least half should be robo taxis.
Yeah.
And I'm just like 50%, and that blew my mind. I'm just like,
I think he's right. I think it's 100 million 2035.
That's what I mean. Yeah.
I think it's less than 100 million. I'm a little more conservative, but that means it's a 200 million thing by 2040 because these numbers add up very quickly. If you would be 100 million 2035, you would be definitely above 200 million 5 years later.
Oh, yeah.
But I mean, people have to understand once transportation becomes ubiquitously cheap, right? Who the hell would not use a robotaxi? Who the hell would bleed money every day for no reason? This is not like some fantasy. It's about, do you really want to destroy your family's, P&L by keeping your stupid car? Or do you want to just save money, never look for parking again, be totally safe, and always get everywhere you want?
Yeah, I don't have to worry about ownership and maintenance and gas and electricity and insurance and, someone scratching your car and your tires and the list goes on.
And the more, the more extreme the advantage, and that's why Optimus is, people do not understand what's going to happen.
Again, none of this financial advice. There could be a black swan event that could happen in 2026, 2027. So take all these numbers with a grain of salt.
This is all a function of this number. If it's not at 10,000 in 2030, all that is not true, right? So you need to decide, do you believe it's at 10,000? Do you believe it's going to be higher? Do you believe it's going to be lower? And what do you think the risk is? Even if you believe it's 10,000, what is the risk it's not there? So you have to consider all these things. Of course, in my model, the risk is considered from my perspective. And I'm very confident on this, but that's why this number is the decisive number. The rest I can guarantee. If this number is true, I guarantee you these numbers because that's math. But this number is the big, $1 trillion question. Is 10,900 correct? And you have to decide this yourself. But listen to Pejjy's channel, watch his people, watch my channel, watch everyone's channel. Everyone is kind of saying the same thing now. It's very interesting.
Yeah, it's very, very crazy. But that's crazy. If we actually see 10,000 by 2030, that is insane.
If we see it by 2030, it's guaranteed that we see it way before, because Wall Street is irrational. Like once you launch Optimus, they will drive it to 10,000 in 2028 or something, but then it will flatline, whatever, something like that.
Like I'm not ready to see 1,000 yet, and we're talking about 10,000.
I think the odds that we see 1,000 next year is kind of high, if you ask me.
Yeah, and your reasoning is because they may make an announcement on Optimus.
And the FSD pilot, Wall Street is extremely irrational. Wall Street basically has only two modus operandi in their brains, which are both completely wrong. So the right modus operandi is what we are doing here. Be rational, see the future, model it out, put in the numbers, be a little conservative. What Wall Street does is either only looking into the past and massively undervaluing it, or only trading on momentum and overvaluing it in the moment with no reason. So that's Wall Street's modus operandi. They have technical traders who go with momentum and drive the stock through 1,000, even though when it shouldn't. And the other guys are like so-called value investors, when you should be a future value investor. You don't invest in the past, you invest into the future. So you have to develop future value, fair value models, which I did, but they're not doing that. So Wall Street is oscillating between these two wrong ways of doing things. So, ooh, everyone is buying the stock, so we are buying the stock. It's like, okay, that's dumb. And the other crowd is like, oh, we are looking backwards, looking PE ratios. It's like, oh, that's even dumber. I don't even know what's dumber. But I mean, that's what they're doing. That's why the stock oscillates around it. And then the real people here, they was like, wait, this is the rational trajectory. 420 now, 8,700 next year, 1,500 2027, 2,900 2028, 5,000 2029, 10,000 2030, based on what we know today. That's the rational fair value. And that's how I measure the stock. If it's vastly over it or below it, then you have to act accordingly.
That's crazy. Yeah, that's absolutely that's mad. And the thing is, with a company like Tesla, you have to get rid of the metrics of the PE. Think about how you value Coca-Cola and all these other traditional companies. You have to get rid of it completely, because it's these companies that are making industries, and you can't.
You have to see the future and model out the future. Everything is still true. DCF models, PEs, and everything still holds true in the sense that you should also always like price a company based on future 10 years of profit. But you can't be an idiot and say, like I said with McDonald's, well, the future 10 years of McDonald's doesn't have burger profit. It's like, why? Are you stupid? Of course, McDonald's will have burger profit. Of course, Tesla will have Optimus profit. That's the whole point. And you cannot just leave it out, then you're completely wrong. So, in a way, the foundational rules of investing are still true. You take a company. Do you want to buy this company for the next 10 years of profit? I think that's a rational approach. But if you don't understand what the next 10 years of profit are, well, then you're wrong.
But Tesla is so different, because it's like, if we're comparing it to like McDonald's, let's say, obviously not comparing it, but if we're thinking about McDonald's, we know in 10 years time, McDonald's is going to be the same McDonald's today. It's just the revenue and profits. But with Tesla, it's like, well, you have two new industries coming in, and Tesla's going to be the leader of it. And how do you value that?
It's true.